Hey, morning everyone. Thank you so much for having us. We hopefully have a pretty entertaining panel for you today, right? We've obviously seen a ton of growth across the space. Within the derivative franchise especially, that's actually where we've seen some of the biggest catalysts. So before I go ahead and introduce all of our panelists real quick, I wanted to just give a quick background on myself and then let you know what we're going to dive into. So Matt Swingle, over at RBC. I oversee our retail QIS solution pod, which is kind of a lot of words, but basically thinking about how we do customizable strategies across ETFs, structured products, and insurance. What's been nice is we've actually seen a lot of overlap between the structured products and ETF world, especially as of late, which we'll touch on today. But in the interim, we'll allow our panelists to please introduce themselves. So we'll start and go down the row. Hopefully the mics work.
Hello, I'm Andrew Sarwick. I am a portfolio manager and the co-CEO of Exchange Traded Concepts. ETC is a white label issuer, so we basically handle all of the compliance, legal, operational issues of running an ETF so that our advisors or index providers who are clients can focus on their strategies and distribution. I joined ETC about 7.5 years ago to start the portfolio management team. Prior to that, I worked in electronic market making and trading for Goldman Sachs for about 18 years. And my first experience with option-based ETFs actually goes back to the very first one, PBP, the Invesco Power Shares CBOE buy right. I recall that ETF, and it was a challenge to make markets in that one. It was unique, the only thing like it at the time. It reset based on the SOQ. There was a VWAP to figure out what the option price was. Honestly, it was a pain, and we didn't really like it. So, fast forward to about 2018, and we started to see the launch of all these defined outcome ETFs, which used options to provide structured payouts. At the time, I thought, who exactly is going to be interested in this? Who's going to sell it? Fast forward tens of billions of dollars later, and a couple of years ago, we started to see all of these single stock ETFs, single stock covered call ETFs. And again, I thought, single stock covered call, it's probably the simplest strategy for an individual investor to implement. Who's going to buy it? So fast forward tens of billions of dollars later, and here we are. And now at ETC, I would say that we're all in on options ETFs. We are a sub-advisor to a number of funds that use options in their strategies. We were a sub-advisor on the first true zero-day covered call ETFs that Roundhill launched, and we're completely in on option ETFs.
Zach Wainwright, founder and CEO of Twin Oak ETF Company. We work with ETC on options-based ETFs. I consider myself an accidental ETF issuer. I started my career doing multi-asset derivative structuring, and then I ran portfolios for a $1 trillion asset manager. And before I launched Twin Oak, I was running a multi-billion-dollar single-family investment team. And we kept getting approached by hedge funds with strategies that we really liked. And I was like, this is great. On a after-tax basis, liquidity basis, I don't want to invest in any of these. I wish there was an ETF. And we went to every major firm that there was, Vanguard, Fidelity, Wellington, BlackRock, many people in this room, and said, hey, would you create these advanced strategies for us? And the answer was no, all for different reasons. And so found myself launching an ETF firm to go deliver advanced strategies built in partnerships with family offices and other investment managers on the other side.
I'm Steve. Can you hear me? That better? There we go. I'm Stephen Weitzel. I'm the managing partner at Reveille Wealth Management. We're an independent wealth management firm based in Atlanta, Georgia. I've got about $1.3 billion in assets. Work with affluent, high net worth families, business owners, corporations, some endowments and foundations. Happy to be here.
Okay, great. Good morning, everyone. My name is Mark Odo. I'm with Swan Global Investments. Swan Global Investments has been running options-based strategies since 1997. We started out in the separately managed account space, then moved to mutual funds, and of course now are running ETFs. We are primarily in hedged equity. We're actively managed with that. Our philosophy is that we're always invested, always hedged. Personally, I've been with the firm for just over 10 years, and it's been astounding to see the growth in this industry over the last decade. 10 years when I joined Swan, no one was really using options that much, and to see them become mainstream has been really exciting. I'm sure that's what we'll be talking about.
Yeah, perfect. So a lot of experience up here on our panel, and honestly want to try to keep this open forum. So we have questions at the end, but if anything pops up in between, please raise your hand, shout out. We have a ton of knowledge up here to help direct any of your questions. So just to start, I actually used our AI tool yesterday, and I asked it to give me a background on the derivative ETF space. And it said, the derivative-based ETF market has experienced extraordinary growth over the past decade, evolving from a niche segment to a significant force in global financial markets. With AUM exceeding $300 billion as of 2025, these specialized investment vehicles have revolutionized how both institutional and retail investors gain exposure to complex strategies. I actually thought that was pretty great. So if you look at how these have evolved, and we'll give some of the background across the evolution dating back from the early 2000s to today, option-based ETFs in particular have been experiencing a ton of that growth. So to start this panel, I thought given the backdrop of $15 trillion of assets now across the globe in ETFs, we're still a fairly small segment within option-based ETFs, but what do we attribute the growth, especially in the early 2020s? Zach, if you want to kick us off.
Yeah, I mean,
No.
can you hear me? Clearly, people want alternatives to just buying data, right? That's why the U.S. financial markets are something like $90 trillion, and as much as has come into passive, it's still only 15 trillion, which is still a small fraction of kind of the overall asset management industry. And so, people are looking for alternatives. They've been looking in, private funds which have underperformed. They have illiquidity lockups. They've been doing things themselves and underperforming what their institutional counterparts have done. They've been doing it in mutual funds and paying, high fees for bad performance and bad after-tax returns. And so, then the next logical step was, ETFs doing that, and some pioneers in the industry making that possible. So it made it tangible. It's more liquid. It's easier to buy. But on the other side, like $300 billion coming into a market and kind of what I'll say, taking kind of like a level one approach to implementing the strategies creates other permutations. You push in one spot and that creates some other ripple effect down the road. And so $300 billion of coming in, covered call funds, buffered funds, there's a lot of innovation in that, but it also creates opportunity for those who are willing to take the other side, like ourselves, and kind of putting our hedge fund investor hat on when we build products and when we manage portfolios to take advantage of that flow and give ultimately better defined outcomes for our clients.
Anything else anyone would like to add to this?
Yeah, when it comes to the growth in the industry, thank you for those comments. But one thing that I always am asked is like, well, why has it grown so much? I mean, what role do these funds serve? And when you look at the way that people use the options-based funds, it's primarily for two purposes, right? The first is hedging, and the second would be income generation. Well, traditionally, that was the turf of bonds, right? I mean, that's why you had bonds in your portfolios, because bonds had historically been able to provide capital preservation and income. But based on the whole ZIRP policy, zero interest rate policy coming out of the global financial crisis, people started looking for literally alternatives, right? Because bonds weren't going to be able to do that dual role anymore. And like we saw in a year like 2022, they performed neither. So I think that's when we really got that escape velocity, when people really started using this and when they realized that that traditional 60-40 fixed income slug was not going to operate like it did previously.
Yeah, and I'm happy you brought up both the hedged equity and the income, because I think those are two pillars we want to really focus on today. Historically, when you think about the option-based ETF space, right, you have a lot of leveraged equity, you have option-based income, you have obviously the buffered that we've seen a ton of growth in. But I think when we really take a step back and we think about all of the different options and overlays that we can apply, the hedged equity or the buffered space and the income space have been kind of two of the primary pillars that have experienced some of this catastrophic growth over the past year. So if we think about ETFs providing downside protection, maybe we take a step into that direction within the buffered and the growth space. How are advisors applying these? How have you seen new innovations? And where do you see the trajectory going? Are there new ways that we can innovate on top of what we've already seen? So I don't know if, Andrew, you want to start here. We want to hand that over to someone else to kind of take a crack.
Yeah, I mean, kind of following on what was said earlier, the part of the reason for the growth in these option-driven funds, I think that there's some demographic effects at work as well. I'll be the first one to use it. The term boomer candy has come up in relation to some of these ETFs because they do provide high payouts. But I think on the other end of the demographic spectrum, there are also younger investors who may have lost trust in some traditional financial products, and they see these new products as a bit more innovative and a little bit, not the mainstream the products that we may be used to. They offer an alternative investment. Thinking about the buffered funds, one of the things that kind of comes up the most for us that has kind of led to this innovation with the first buffer funds is really the growth in flex options, right? Listed options have been around for a long time. Flex options, which are flexible options, they essentially are like OTC options, meaning that the terms are flexible. You can define the strike, the expiration date, the exercise type. These have been around for a number of years, but they've really grown with the issuance of all of these buffered ETFs. And they allow you to have different order types and construct products in different ways where you might target a certain level of premium or a certain level of moneyness. And that market, I would say, for flex options is still nascent, but it's kind of grown alongside of all of these buffered ETFs that we've seen come to market.
I agree. And then from the Swan side, I know there's a ton of tail risk hedging capabilities over there. How have you really been seeing that adaptation? And have you been seeing more retail type focused as this builds as well, outside of just institutional historically?
Yeah, we've seen lots of growth certainly across our product lineup. And just full disclosure, Swan does sub-advise with a buffer product, so we kind of work both sides of the equation. One of the things I found real pleasing is the fact that Morningstar has adopted this better framework for analyzing options-based funds. I mean, you look back prior to 2018, and there was just one category called options, right? Well, I always said that's like having a category called stocks, right? I mean, it's just a financial instrument. It's how you use it that's important. And what a more recent development with Morningstar's classification is this whole dividing a line between the actively managed hedging strategies and then what you were mentioning, the buffered ones, which are by and large rather passive in their nature. Now, I think the passive simple nature of the buffered ones has accounted for their growth. They're very easy to understand, very easy to explain, but there are other people like Swan and like Twin Oaks who have kind of more innovative ways of hedging strategies and trying to be more active in that space. I mean, and this could be a whole discussion in and of itself, but options are wasting assets, right? And do you just hold on to them till they expire, or do you try and do something else with them? Do you trade them? And that's what Swan does. I know Twin Oaks has some other philosophies when it comes to how to best implement those in the products.
Yeah, I mean, what I would say.
Somebody want to pass?
All right, let's try again. All right, what I would say is first I'd say one of the reasons why this has exploded and there's just been a lot of education in the industry that has happened, from kind of legacy asset managers for new innovators coming and explaining. After the financial crisis, derivative was like a dirty word, right? It's what blew up the economy. And so there's just, 15 years later, I think people have a much better understanding of how it can be used in your portfolio, how it can help shape the risk kind of delivery of an investment. And it's just really a tool in a toolkit. As Mark alluded to, there's a lot of different ways to implement hedging. There's a lot of different ways to use derivatives in your portfolio. Funds like JEPI selling covered calls, right? They sell a fixed amount of covered calls on the whole index, a set amount, rolling it every single month. And that just creates opportunities for innovators to take the other side, right? As opposed to getting your equity exposure on by just going to buy, the S&P 500, you can, go long short-dated covered calls, which you're taking advantage of that, forced automated selling from the covered call funds, and you could sell puts to the buffer funds, which are forced to buy those funds, and so you're kind of getting paid in a way to put on an exposure that you otherwise wanted to do. And so it's just, for us, it's just about thoughtful approach of implementing that, and that's kind of what we've done our whole career. And at any given time, that can move around, and that's kind of what we think about is the next gen of options ETFs coming into market. It's buffer funds are interesting, covered calls funds are interesting. It's done a great job on the education piece. But as people start looking for more advanced solutions, I think taking this kind of hedge fund toolkit that we've spent our whole careers, working with my partner, works for Michael Burry, I work for someone else in The Big Short. It's taking those tools that we've seen used throughout the industry and kind of applying it in a liquid wrapper is the innovation, and thankful for all the education that kind of has happened before this to help get people comfortable with options and help kind of open up this market.
I'm happy you brought up the education, because before we jump to the next segment, Steve, I'd like your thoughts here on the asset management side, right? When you think about how advisors are applying these, one, are they cognizant of what they're purchasing, right, in some of these defined outcome-driven vehicles with flex options embedded within them? And then two, how do you think about that from a broader portfolio implementation over $1 billion in assets?
Yeah, so I think first and foremost that the adoption of something like the buffered ETFs is a simplistic way for advisors who are still largely buy and hold oriented from the way that they construct their portfolios to be able to introduce some level of downside protection for their clients. And so I think that's why you're going to see a lot of adoption of those types of strategies. I do think, to Zach's point, though, where there's definitely going to be some opportunity going forward, and maybe the next gen of this on the let's say the income enhancement side, is going to be that you have these funds that are either writing calls or writing puts indiscriminately, and I feel like where they miss is they don't do the first step, which is to understand, is this environment that we're in conducive to writing calls or writing puts? And so we manage a lot of appreciated positions for clients, and we're helping them with either trying to protect those positions or provide some enhanced income. But the one thing we know is in those situations, we don't want to lose the stock. But there are times still where we're going to want to write calls. But if the stock's in a bull market, we'd be much better off writing puts. So we need to have something that has some discretion and flexibility that's going to start at the origin point of what's the environment and the trajectory for this security, and how do I want to position around it to give myself the highest probability that that option that I write expires worthless.
Right, and I think that's a big piece to some of the success that we've seen in this defined outcome and income space, especially as we start to see increased volatility, right? I would imagine more and more folks are kind of knocking on the door saying, how can I either monetize this? If you want to try to monetize sideways markets that we're kind of anticipating, then we think income. If we want to be more risk averse, then we're thinking downside protection. And the beauty of working with everyone on this stage is that we can kind of find a solution that can monetize that directional view one way or the other, right? And I think that's been very innovative to the ETF space, where it used to be a little bit stringent in what that wrapper used to look like or what those rules were, and now there's a lot more customization that we can unlock, and that's been exciting. The next sleeve, as we mentioned, so we kind of touched on some of that hedged equity, buffered downside, is income. And I think this is a very, very exciting topic, especially from experiencing a lot of my past work in the structured products desk. Last year, we saw $200 billion of structured notes issuance in the United States, which, to put that in comparison, when I started my career in 2010, we were 30, I want to say. So it's been exploding. Now, that's attributed to markets rallying and notes are getting called, but certainly education, advisor penetration. But one of the feedbacks is that, these are clunky, they're difficult to use. If you think about that $200 billion market, 60% of that is geared towards income-driven solutions within structured products. So now, as we start to think about call overwriting, as we start to think about some of these different auto-callable strategies that are being implemented, different ways to source income, as we touched on with the JEPI fund earlier, well, now all of a sudden you have an easy button almost on applying that type of methodology into an ETF. So, Andrew, maybe it's good to start with you white labeling. It feels like kind of every time you open up your browser or you glance across new ETF news, there's a new market maker, there's a new provider that's thinking about ways to drive income-oriented solutions. How have you been seeing that wave, and where do you really see that growing?
Yeah, I think that we've seen a lot of innovations in income-producing option ETFs. I think that one of the biggest trends that's been a part of this is the rise of zero-day option contracts. It's something that was a very small portion of option trading 5, 6, 7 years ago, and now actually dominates option trading. So, you know, the way you've seen some of these covered call and income-producing option strategies evolve is that, you know, the very first one was typically a monthly write, you know, paying a regular distribution, and you've seen that time frame shorten to the point where funds were writing weekly options and now writing 0-day options or 1-day options. And the thinking behind that is obviously with an option, the shorter the time to expiration, theta decay is not linear, right? So theta decay occurs more rapidly the shorter the life of the option. So the thinking is that you have more theta decay by selling a 0-day or a very short time to expiry option. And I think that's been one of the trends that we've seen as these 0-day option funds have become more and more popular.
I think real quick, because I obviously want Steve and Mark and everyone else to chime in here. We had our equity derivatives strategist speak at a conference last week, and over 65% of volume on options that are traded in the market now are 0-day expiry, which obviously speaks to a lot of ETFs and also, of course, a lot of retail now opening up Robinhood, getting involved there. So it's really changing kind of the market reaction that you see on a day-to-day basis. But anything else we'd like to chime in on there?
We spend all our time making sure our funds don't have income because we work with family offices, wealth managers, et cetera, that are taxable on building strategies. And so for us, we spend all our time trying to figure out how to remove the income stream or make the income stream more tax efficient. But you know, we spend our time worried about that. You know, so we spend all day talking about theta decay, gamma. 0-day options have a lot of gamma in it that creates other problems. But we don't talk about that because, you know, we worry about that so you guys don't have to, right? Like options can be really complicated. When you work with a firm like us, Swan, ETC, like what you're getting is people who will worry about that and optimize for that. And so it's important when you guys are interviewing managers that you're thinking about putting into your portfolio that are they worried about that so you don't have to, because it moves every day, it impacts the market in a lot of different weird ways over time. And so you want to make sure you're working with kind of sophisticated counterparts.
Yeah, if I could just add to that, I do think that this is a space where the due diligence does pay off. I mean, if you are looking at, say, for example, a large cap value fund, there's really not going to be a whole lot of difference between what the end portfolio looks like and what the process is. But when you start getting into this space, there is a lot of variation. So certainly it's not the kind of thing you'd want to sit down with your client to do and explain, you know, time decay and stuff like that. But understanding, you know, the kind of value prop and how the different funds are run is very important. I mean, for example, we were just talking about the fact that, you know, time decay, the value of an option decreases more rapidly as it gets close to expiration, right? So if you're writing options, that's great. That's why these 0-day TDs are great. It's because more often than not, they expire worthless. But what if you are hedging? What if you are long the option? What if you're holding on to those put options? Well, just, you know, in our case with Swan, we buy 2-year put options because we would like that nice fat expiration window, and we'll only hold that option for the first 12 months, but then the back 12 months, we don't want it. We get rid of it. We roll out of it, so we're not faced with that time decay. Now, there's going to be some times when that works great. There's going to be other times when it doesn't work as great. But understanding these nuances and these subtleties is a very important part of the due diligence process.
I'd like to pull on that string for a minute. And actually, Stephen, this would be interesting because I want to hear how you kind of apply this as you think about responsible growth within income generation, like you mentioned. You have funds out there that are doing call overrights on 60, 70 vol names, generating 150% dividend yields that are being distributed monthly. There's significant price erosion, and obviously you need to really do your diligence. And then you have some of the ones we mentioned earlier, the JEPIs and so on and so forth, that are generating that high single digit, low double digit. How do you think about that as it applies? It's obviously a different customer base. When you are kind of going into, let's call it the lab, and creating some of these strategies, are you first identifying the customer base, and then as a wealth manager, how do you necessarily do your diligence, right, to decide what's appropriate? And obviously it can vary by client, but there's a lot of different ETFs out there. How are you making that decision, and how are you kind of filtering down?
Yeah, so that's a good question. So we begin all of our relationships with a financial plan to try to identify what the client's needs are, you know, what their objectives are, and on the whole, you know, we're going to we choose to manage risk, what I say, from a conscious standpoint, right? That risk is not managed just by diversification and asset allocation alone. You have to make the determination whether or not you want to be exposed to risk assets or not. Cash is a conscious position, and we all tend to forget that until it really matters. But the way that that you can use, some of these options ETFs in terms of portfolio construction, there obviously has been a tremendous move from a demographic standpoint. You've got the baby boomers that they're now in a position in their life where they aren't as focused on capital appreciation as they used to be. A lot of our clients, they've already been successful. They don't come to us looking to hit another home run. They say, look, I remember when I had 250 grand for the first time, and now my portfolio moves by that in a single day sometimes, and it makes me nervous. So I'm looking to find a way to de-risk. I want to try to have more defined outcomes. And so that's where just implementing options into a portfolio can help you do that, whether it's around just asset protection, whether it's income generation. And so we're definitely going to have that as part of somebody's portfolio because, again, they're not coming to us with a blank slate. And so we've got to try to find a way to take what they have and position it for where their life is going moving forward and make sure that what we do remains adaptable because the market environment's always going to shift and we can't always have them positioned the same way.
Yeah. Anything else to touch on there? And we can go on to the next time. Go ahead. Sorry.
Yeah, maybe when it comes to setting expectations, I think that is very important with these things, and maybe this is going to bleed into probably some of the questions about risk, but people hear what they want to hear, right? And if they hear 70% yield, their light bulbs go off and they think that there's some kind of magical money machine that's going to produce 70% yield forever. And one thing that's very important in this business, I don't know if you're talking about options or whatever, is that there's no free lunch, right? So in order to generate that 70% yield, you're giving up something, and it's important to understand what that something is. And again, the education is very important. It's important to work with providers who are very upfront about what the trade-offs are when it comes to the risks and returns and whatnot. But yeah, I think that is going to be a challenge, and especially when it comes to the risk management about what happens when that 70% yield goes away or your capital base disappears on you.
Yeah, and the same thing.
Yeah, 70% of a much smaller number is not great. So that's one thing where I would say you see if there's a product out there that's telling you it's going to give you a 70% yield, are we really going into that with rose-colored glasses thinking that that's the way it's going to turn out? If it sounds too good to be true, it probably is. But I wonder for a lot of these strategies that are out there that are using zero-date options or even weeklies, that sometimes the juice isn't worth the squeeze, and you had people who were shorting vol a number of years ago, and they were picking up pennies in front of a steamroller, and they collected a lot of pennies for a long time until they were under the steamroller. Yep. So those are the concerns that I would have for people who go into these things blindly. I think the issuers of a lot of these things, they want to make sure that they define exactly what the risks are that investors are taking on, and then it's kind of a buyer beware type situation. If you want to have it, here it is. But in terms of allocating money into those products, just don't go in with the rose-colored glasses.
Yeah, I don't know, Steve. If you're growing 250K total to 250K day swings, I think I know where I want to put my money, man. As you think about these customized ETFs and indices now, right? That's been a big, big growth space. We see it with investable indices. We're seeing it in auto-callable ETFs that are coming out. When we were just mentioning some of the time decay. And you have, if it's a 2-year option, you're unwinding within a year. Are you more frequently now using systematic type option strategies to execute these types of plays? Is it active management? Is it a balance between the two? How do we think about customization, indices, and kind of how that's evolved with technology and frameworks and implementation. So Mark, maybe if you'd like to start.
Yeah, I'll be brief. I mean, when it comes to Swan, what we always do is we manage the delta, meaning our overall exposure to the market, right? I mean, the way I've always explained delta to people who don't have an options background is like your portfolio's beta, but it changes, right? I mean, that's the thing with long-only thing, beta is beta, it doesn't change, but when you're running options, your sensitivity to the market changes. So you can be in a situation where the market's run up a lot, and all of a sudden, guess what? Your option is so far out of the money, it's not really protecting you anymore. So you can either do nothing, or in Swan's case, you can actively manage it. You can re-hedge, you can, that's the advantage of using an exchange-traded option, is that you can just roll out of it at our discretion, and what we're doing is managing the delta. Same thing on the downside, right? If the markets sell off by a lot, and then that option is deep in the money, and it might make sense to capitalize on some of those gains, sell that option at a profit, and turn around and sell it. So that's something we've always done. There's certainly other ways that you can manage delta and your various Greeks to provide active outcomes, which are all different than the buffered defined outcome strategy. Because one thing I'll say, I mean, it's like, the one thing about the defined outcomes is the only way that they can say that, look, this is your cap, this is your floor, is if they set up the trade and don't touch it for a year, right? That's the only way you can come out there and say, like, this is what you can expect, is if it's passively managed. And that's fine. I mean, passive is one way to go about it, but certainly from our perspective, I know Twin Oaks has some thoughts on it as well, there's other ways to skin a cat.
Agreed.
Yeah, I mean, what I would add is, I mean, so we start with, we build custom ETFs with our end client. So like we develop these strategies in partnership with the end user, because fundamentally, I actually just don't think we need another fund just to have another fund. I think that's the whole industry, right? Like there's the stat of there's more ETFs than there are stocks. There's like 20,000 private funds. How many mutual funds are there? Like, do we just need another fund just to have another fund? And so we start with like, we want to give clients what they want by building it in partnership with them. And so it's kind of this mutually beneficial relationship where like we're building a strategy to fit into a portfolio, but if it works for them, it'll work for other people. And so we start with that kind of approach and framework. But like, just to have another fund, I think is, like there's 1,000 new funds coming to market in 2025, like throughout the whole year. Like, it's hard for advisors, it's hard for end clients to decipher between the litany of new things being offered. And so we start with, are we building good strategies in partnership with the end users that we think we could build and invest in for the next 50 plus years? Because that's the mindset that we try and take both with our clients and then kind of developing just strategies that we would buy and hold, where the active management's happening on the inside. And to your question on kind of systematic versus active, for us, it's both.
Yeah.
Because at different times, there's different things that you can do. The more repeatable a process becomes, like in one of our funds, we're harvesting a risk premia in the option market. It's existed for 40 or 50 years really consistently. The value of that risk premia moves around based on the environment, but it's been fairly persistent. So like that is more of a systematic strategy, but at times like we'll supplement that with kind of active investor mindset and how we build that.
Yeah, I mean, I think that Zach really gets at something that's it's a double-edged sword with all of these ETFs that are coming to market, right? I think that there are kind of two ways to look at it. I mean, at ETC, we're a white label issuer. We're not doing the research or providing the alpha. We're providing the execution. Many of the strategies that we execute for are systematic, but we also work with active managers and implement their strategies. I would never discount the issuance of all these ETFs. I think that you can think of some of them as widgets or tools, something that's systematic, that has certain characteristics and properties, a way that you expect it to be executed, right? Many advisors are not going to want to sit there and sell zero-day options every day, right? I mean, we have a team that's there at the desk doing this every day. So you can see the proliferation of these ETFs that are systematic as sort of tools and building blocks, and then other advisors who are able to use them and intelligently put them into portfolios to give you the shape of risk that you want.
I have a slight curveball real quick because I was just looking at my notes before we jump into the last segment of Tailwinds because I'm actually curious on my thoughts. So the U.S. is 10 trillion of our total global. Why do we think, and that's about 75%, right, of the total AUM for ETFs roughly. Why is it predominantly in the U.S. and when do we think that'll start to take off in other regions, Asia, Europe, Canada, et cetera? Anyone want to take a stab at this again? Sorry, we didn't really prep for this one.
I think one of the major reasons that ETF adoption in the U.S. has been so high is because of the tax efficiencies And I don't know what the tax consequences are of investing in those other jurisdictions. So perhaps if they don't have those same issues, then maybe it can be more stunted. But here in the U.S., I think the tax efficiency has been a really big deal.
Yeah, I would agree with that. Back to the comparison of structured products too. If you get an income note in a structured product, you're getting ordinary income. Here, with the way that a lot of these have been evolving, right, it can now be return of capital with 90%, say, of your distribution rock treatment, which is extremely advantageous.
Yeah, I just sat in on the UCITS section upstairs. Upstairs? Downstairs? I don't know where I'm in. But one of the other floors where they had the UCITS discussion, and one of the things that was interesting to me, they were talking about the European market, and they were saying, like, Europe is so far ahead of us with crypto and that type of ETFs. Okay, great. But apparently, this is what I didn't know, it's kind of got me a little interested. They said that there's only $5 billion in option-based defined outcome space, and you compare that to what we have here, they said that's going to be the next growth frontier, it's going to be Europe. I'm like, oh, okay, well, jot that down.
Yeah, and I would add, like, when I first, I had invested in ETFs, my whole life. But when I was first kind of introduced to like the inner workings of the ETF industry, I was at a large asset management firm, and 9 years ago, like, oh, we should launch active ETFs. About a week ago, they finally announced that they're getting into the active ETF game. It took them 9 years to get there, and so yes, there's a lot of innovation happening in the U.S. I think at certain moments it looks really fast, and at other moments it looks like glacially slow. And I think international markets are following as well. Like, we're working with, a very large, sophisticated Asian financial institution. I think the innovation is coming to those markets.
Yeah.
It's just a matter of time, and it's just taken some time to get comfortable with it, to find the right types of partners for them to enter into the market. But I think the next 5 years you'll see a lot more innovation internationally as well.
I'll try not to be too wonky about the operations of ETFs, even though that is my job. But going back to the thank you. Going back to the the tax implications of all of this trading, one of the innovations in the U.S. In recent years is that there's the ability to deliver options in kind, which is really kind of the secret sauce behind ETFs and how they avoid realizing distributable gains. This is something that it really is an innovation. People were not doing this 10 years ago. The first option ETFs were not able to utilize in-kind transactions for options, but that is a recent innovation that I think has been contributing to the growth.
Yeah, we've absolutely been seeing that. So we're going to hop into just some tailwinds, and then I want to give some time for questions as well. But to recap some of this, so we saw, call it the mid-2000s, 05, 06, the evolution of some of our first derivative-based ETF, leveraged ETFs, et cetera. That gained around $50 billion in assets through 10 years. Then we have what we call like the expansion phase, right? That happened in the mid-teens, 2015, et cetera. And that's when we started seeing a lot of the, call it sector-specific exposure. We got away from some of the broad-based income, or broad-based indices rather, and now we're looking at 2020 and beyond, where we've grown from 50 to really 300 in the past 5-6 years. And that's the acceleration phase because of a lot of pieces that we've discussed. And for those that sat on the last panel where they were talking about active managers, the question was brought up, what inning are we in? And it was pretty much consensus across the board that it was, early innings here. So as we think about wrapping this up and we look ahead to next year and beyond, what are some of the tailwinds? How much room do we have to grow? And what are you excited about most? So real quick, to touch on those quickly, and then we'll open it up. So why don't we start, and we'll just go down the list if you want to kick it off.
In terms of tailwinds, I think that there is still, a lot of opportunity to wrap additional option strategies into an ETF wrapper and make them more accessible for investors. It does present a challenge for advisors because I think it goes back to, you need to know what the product is doing. You need to understand it and be able to explain it to who your ultimate clients are. But I think that there are any number of strategies that are ready and set to be wrapped up into an ETF and made more accessible to people.
Yeah, and what I would say is that, I'm a big student of kind of like financial history, and so when I decided I was going to launch an ETF firm as like an accidental issuer, I sat down with a lot of the founders and pioneers of the ETF industry just to like pick their brains and learn about how the industry has evolved. And I asked that same question, like, what inning are we in? And they all said the second inning, which is kind of amazing considering there's $15 trillion in it and it's 30 years old. And I truly do think that. And so for us, like, we launched a year ago. We raised about $500 million in our first year. And I think the tailwinds you're going to see, specifically like for Twin Oak, is like we're trying to partner with other institutions on developing and bringing their strategies into ETF form to kind of make those return streams available to our clients, to their clients in a better vehicle. And so we're working with like multi-strat hedge funds and other asset managers on doing that together because, to Andrew's point, like it's complicated when you try and blend together something that was built in the 1940s with a multi-strat hedge fund strategy today. And so I think you'll start seeing those institutions come into the market as they get more comfortable, as the pipes of the ecosystem are more well understood and brought in to take advantage of kind of advanced strategies.
Just to real fast pull on that string for a second. We've obviously seen a massive wave. There was just news today about Vanguard coming out right into their ETFs, or their licensing rather expiring. And there's a massive wave of fund managers, et cetera, that we expect to come into the ETF space. Do we believe we have the infrastructure to support all of this right now as it currently stands? As you mentioned earlier, we don't want to just launch another fund to launch a fund.
Yeah, I mean, I think you're referring to the share class.
Yes.
ETF is a share class. So we don't play in that space. We hear a lot about it from our vendors and our service providers and other legacy asset managers. It's complicated. I think ETC probably is better positioned to talk about it than I am.
Yeah, no, I mean, I definitely can. When I think back to my experience on the market making side, right? This goes back to ETF, a bit of ETF history here. When I started, SPY traded on the floor, it required about 6 people just to manage the order flow in SPY on the floor of the American Stock Exchange. By the time I left Goldman, in 2018, we had a team of maybe 4 or 5 people that was making markets in 700 ETFs. When we think about these, the potential for all these products to come to market, I think there's been a lot of efficiency and automation on the market making side. I think that the asset manager side is just now beginning to see the start of the automation that is necessary to be able to handle all these products.
Thank you. I'm sorry to derail, Steve. If you...
No, that's all right. So I would say, just as a reminder, that not all baseball games are 9 innings. So, it may be early innings, but the game could go on for a long time. I do think that from my seat, at some point in the future, I would be surprised if we still see the open-end mutual funds, exist as they do now. Now, whether or not these, they're not all going to have options, obviously traded inside of them, but a lot of these fund conversions to ETFs. So, my firm actually participated in one of these. So we represented a majority stake of the assets in a PIMCO mortgage-backed securities fund that they converted into an ETF. So they now have I think it's the first actively managed mortgage-backed security ETF, PMBS. So they came to us when they were wanting to convert this over to make sure that we were okay with it. I think that is where we're going to see a huge shift in our industry. And the biggest thing for the benefit of investors in some of these funds, so I think about a company like Vanguard. If they were to take their S&P 500 index fund that has hundreds of billions of dollars in it, and people have been accumulating positions in this fund for decades, that if they were to simply convert the AUM in that fund over to VOO that has listed options traded on it, now if I hold that fund, so currently I don't have any way to be able to enhance my income if I want to. I can't write options against that index fund. I can't buy puts, against it. But if it converted into VOO, I would be able to do that. And so I think for the benefit of investors, we're going to see more of these legacy funds convert into ETFs. I would be interested to see how many of them end up with exchange-listed options that investors would then be able to use on their own to either enhance their income or provide some downside protection.
Synthetic exposure, yep.
Yeah, I've been sitting here trying to come up with a way to make this answer not sound so nerdy, but I can't, so I'm just going to plunge in. So I think if you ask about the tailwinds and what inning we're in, well, I really think that for this space, for the options-based space, it's going to be a derivative of what happens in the long-only space. I mean, the markets are trading near all-time highs. If and when the markets eventually do sell off and correct, and we have a true bear market, if these types of strategies perform well, then you're going to see a huge surge of interest, right? And then the same thing with the other side of the equation in the traditional long-only space. I mean, what is the future of bonds? I mean, yields are certainly better than they were before, but when we start to look at the yield curve reflecting all these new fears about the dollar strength and central bank independence and out-of-control budgets, people are looking for other ways to have some of that capital preservation. So depending on what inning we're in with those other traditional markets, I think our market here, the options-based space, will be a derivative of those.
Thank you so much. So to our panelists, thank you very much. Before we close out, though, I'd like to open it up. Do we have questions from the audience? We have like 2-3 minutes left if anybody would like to ask anything here. Going once? No questions? All right. Well, Mark, Zach, Andrew, Steve, thank you all so much. It's been a pleasure having you up on stage. Enjoy the rest of the conference, everyone. Thank you very much.
Thank you.